Good morning, everyone. Welcome back to the rationalinvestor.co. Thought I'd do a little tutorial here for you guys today. Post it maybe on YouTube and Reddit. Something that maybe will help you on a day-to-day basis in the marketplace. And that's sort of the purpose of today's video. No real update or anything, just a tutorial. And hopefully I can add it to the library. So what are we going to talk about today? It's interesting. I noticed harmonic patterns are getting a lot of activity, a lot of interest. This person in particular happened to be looking at the what is this? The British pound, New Zealand dollar forex cross. Holy moly! And you guys recently have probably noticed I posted some U.S. dollar charts and some Canadian dollar charts. Wow, that's cool. So you guys got to sneeze halfway through that. And in response to this person's post, this was a chart that I've actually been very interested recently, and I had postulated that maybe this was a bearish Gartley, although, these are some pretty crazy candles in here. Nice bullish turn on the Canadian dollar. That's not really the purpose of today's post. I thought it was interesting because as I was sort of reading through this, I noticed that there's a lot of users and a lot of people in the public that are very interested in harmonic patterns, but really don't, they want to trade them, but they really don't know what to do. And where to go and where to learn from this stuff. And it was interesting because today I just sort of, just did a really simple search. I just said harmonic patterns YouTube, right, just to see what would come up. And what I noticed is that a lot of these patterns, they don't actually talk specifically about how you would use them in trade setups. Guys are like, oh, wow, look at this harmonic pattern. It hit this target. Way to go. Oh, awesome. But nobody really says, like, how do you actually trade them? So I thought I'd take a few minutes today, sort of in response to this Dan DC. And I wrote him actually a fairly lengthy response this morning. Basically, he just asked me, can you please explain a little bit more? And I just drew up this chart as an illustration, and I thought it was so good that what the heck, I thought I'd maybe do a video of it too. So, basically, we'll use this gentleman as sort of a test case. And I don't even think he knows that we're going to use him as a test case, but anyway. This person basically, it says, can you advise me a course or books to read on how to do this? And this person said, well, being a full-time trader, it's a lot of work. I mean, it's not easy. Just seeing a harmonic pattern and then boom, being able to trade it is, apples and oranges. And, for this person in particular, I just said, I don't want to step on anybody's toes. I'm Canadian, I'm nice and polite. But I do run a trading program where I teach people, sort of what the basics are of how to trade. My direct experience as being a broker for 15, 20 years, being a funded prop trader. I think I pretty much know what it takes to trade and manage yourself professionally. And in this response in particular, I said, I do teach harmonics in my trading program. And here's a cheat sheet that I like to use. And I've just put it up on the Google Drive. And everybody, you're more than welcome to go and grab this. It's basically just a shared sheet. And these are common harmonic price patterns that we look for on a daily basis. And they're very powerful. I mean, what actually funded me as a prop trader was this ABCD pattern and then trading a trading model just specifically off of it called the bot, right? I mean, extremely powerful trading stuff. So, in response to that gentleman's query, where the heck did I have that? Maybe it was just back here. There it is. He wrote back and said, Saw the image posted, but I can't understand one thing. Retracement should be between two values, exactly one value, two values. And what I thought I'd do is just take some time and sort of explain how I use the harmonics. It doesn't necessarily mean I'm 100% right. But you know what I found over time is that generally speaking, when you see these harmonics come in, it's just a good guide. And so what I told the gentleman was, you know, these numbers are guides as to the approximate location of each turning point. So very handy information, and the more closely it adheres to these specific levels, right? And if we zoom in, for example, you know, like the Gartley, that's 88.6, you know, this number that you see here, right? Hopefully you can understand that would be, you know, point C is 88.6 retracement of this A to B point. And this 38.2, that's this C is a 38.2 fib off of this A. So it's, you know, here, I love to do this because it's nice and simple for you guys here. Let's just grab one. All right. If we say our price pattern looks something like this, right? The 88.6 is, and this is, you know, very rough, right? But that's that number there, 38.2, right, is that number there. So basically it's a guide saying, okay, well, you know, basically it's got a window right there to rally into. That's sort of the way that I would interpret it. Some levels you'll see here, there is no flexibility, right? If this is a Gartley, then this A to B should definitely be 61.8 off of the X to A, right? That's sort of written in stone. And if it isn't, you'll notice, right, that something like the bat, right, you see its flexibility is 38.2 up to 50%, right? The crab, 38.2, 61, right? Butterfly, it's 78.6, right? So just understand when you see those. And then, of course, subsequent ratios, if you have a little bit of flexibility in this ratio, right, then obviously you're going to have a little bit of flexibility in this following ratio. Okay, so hopefully that explains the idea of why there's multiple numbers there you sometimes see, because basically it is a sort of the price does have a little bit of flexibility. So the second thing that I thought I'd do for this gentleman today, and I thought it was a good idea, is I just sort of try and find an example and just sort of demonstrate how, yeah, there's a harmonic pattern, but that's not enough to justify a trade unto itself. And so what I teach in the course, and basically this was the response that I gave to this gentleman, was I said, I teach in my program setups. Setups are combined reasons, at least 3. And the interesting thing is, if you get 3 legitimate reasons to take a trade, it's remarkable how many more reasons you can find. But what's interesting is if you can't find 3 reasonable reasons to take a trade, like let's say you can find 2, it's remarkable how often you see 2 good reasons to take a trade, but the trade ends up falling flat on its face. If you can cross that 3 thresholds, then it's surprising, because then you throw on momentum and then you throw on volume, and you know, you just keep going, and it's like, holy moly, there's not 3 reasons, there's like 10 reasons to take a trade here. So try and remember that 3. That's such an important number. So like I said, a typical setup for us says that there's at least 3 reasons to take or consider a trade. So harmonic patterns may be one of those reasons, but that's not in itself enough of a reason in itself to take the trade. As I said, I teach classes, and really we've taught now 3 full semesters of these programs, and I think we must have trained about good 40, 50 traders, and man, we have some just killer traders coming out of the program. Oh my God, these guys are incredible. So I know this stuff works, and basically this is like 20 years of combined experience. So the long and short of it here, I said, is, in our courses, right, we cover 16 different reasons to take or consider a trade. Everything from moving averages to commitments of traders data to harmonics to fibs to candlesticks to market structure. I mean, we go on and on and on and on and on. So, and we actually call the, when we're looking at all these different reasons to consider a trade, right, all the different tools you can use as a technical analyst and fundamental analyst for that matter, we call that the candy store, right? This is the fun part of trading, right, where you get to go and play with different indicators. Keep in mind, and I hope everybody who understands is watching this, is there's 2 parts of trading, right? There's running a small business. They often call this the one perfect business. But that's all about what we call eating our vegetables, right? Risk management, working with a trading plan, building setups and committing to those, committing to diarizing your trades, committing to reviewing all of that, right? I mean, that's all about eating your vegetables. And the interesting thing in our courses, right, is nobody likes doing that. It's boring, right? But, we're running small businesses here, right? We have to act like successful small business operators. And there's a number of key things that every successful small business operator does. And those are things like, persistence, right? Determination, drive, right? Positive mental attitude. Come to work every day with a smile on your face. Those are, anyway, that's eating your vegetables, right? We cover that in detail too. But anyway, the point of the matter here is when we get to the point of visiting the candy store, we've already eaten our vegetables. We're good kids and we've eaten our vegetables, and now it's time to play. And in the candy store, we just examine a number of different reasons to take a trade. Like I said, in here, we really should have at least 3 reasons. So what I said here is, if I see a potential harmonic pattern, I would really like to see volume and momentum and maybe even like a nice candlestick pattern all confirm that indeed we've got a trade set up here, i.e. 3 reasons, right? And then I actually like to use something like a candle pattern to identify entry and risk management. So, this person that was asking in particular was like, okay, I want to trade harmonic patterns. Now, where do I put my stop? Where do I enter? And where do I take profits? And interestingly enough, what I've found is that if you see a harmonic pattern, and this one example was off the daily chart, right? These can often be, significant market events, right? I mean, this one took quite a while to develop. And as a result, it's going to have quite a bit of play if it's validated. And, this is a bearish bat. We had a Gartley a little while ago, and man, it just went on and on and on and on. And it's interesting because I think we might have a potential bearish Gartley develop here on the US dollar, which, in itself is a whole conversation. I suppose, if you're interested, get in touch with me or come on over to our site and join our chat room, which is a lot of blast. I love this chat room. It's so awesome. Anyway, back to our story here. So the point is, what does a good setup, look like? And as we said, we want to have 3 good reasons. Where the heck did that chart go? Did I get rid of it? There it is. So last summer, right, we had a bearish harmonic pattern develop in Bitcoin. And it was interesting because I just started the teaching programs that I made reference to you guys. Right in here, Great timing, eh? We called it the Rational Investor School for Bitcoin Trader Development. So not only did we, and the interesting thing is a lot of people who take our program don't even trade Bitcoin. So, you know, this information is applicable across all assets. But the point here is what a time to start a Bitcoin related business, eh? Anyway. I didn't actually take this trade, which is ironic because at the time, I really wasn't a big fan of shorting Bitcoins. The account that we had was on BTCE, and I really had worries about Russian mafiosos and all that kind of stuff. So I didn't want to get into, you know, leverage trading with them. I've since changed my tune, and I have been taking shorts and stuff off this little BTCE account. But really, on balance, you know, what this is more an illustration of what, you know, best practices rather than a trade that I actually did. You know, obviously hindsight's always 20/20, right? So just so you understand that. Okay, so last summer we had this big rally, and you know, here is a trade that I did do. This was what we called the trade of the year for 2000. I guess 2014. Yeah. Nice double bottom, big breakout, OTE, blah, 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 blah. Take the course if you want to learn more about that. Had a big rally. And what I noticed through the rally, and something that we teach in our volume part of the course, is what we call the impetus, right? And we notice here that the up candles, the green candles, right? The volume on the candles is getting lower and lower and lower. And in essence, by price actually moving to new highs, even though volume did not, this is basically a divergence in the bullish impetus. All right, you can literally see the green candles, or the green volume bars, getting smaller and smaller and smaller. At the same time, if we look at the red candles, you can see the red candles, or the red, you know, volume bars, they got bigger, right? This was a big event right in here where volume, the selling volume broke out here, right? Actually higher highs. So the long and short of this here is we had this volume divergence even though we had a big rally, right? So as I said earlier, we want to find situations where we can see multiple reasons to take a trade. So believe it or not, before the harmonic pattern developed, we actually had a volume divergence developing. So in this scenario, we said, what are our three reasons? The first reason was we had this volume problem, right? Then, you know, through the period, and you guys remember, I don't know whether you remember or not, but this was right through the first U.S. government Silk Road auction. And it was really interesting because this was the China ban. Once they banned, then there was a vacuum in news. And when that vacuum, they took price back up. Then price began to drift down. There was rumors about this government auction that put a bid into the market, and that set up this Gartley that basically this was a buy on the rumor, the U.S. government auction rumor, sell on the news. This was like literally, I think the auction was either this day or this day. It was right in here somewhere, right? So it was to sell the news. So, you know, fundamentally, you could argue that there's another reason, right? Buy the rumor, sell the news. In fact, that's what we teach in our liquidity events. So it is another valid reason. And like I said earlier, you often find that if you can find three good reasons for a trade, there's probably a lot more, right? And if you start looking at other stuff, you go, oh, yep, there's one, there's another reason, yada, yada, yada. So remember our cheat sheet, right? We basically have the parameters for the bearish bat. And as you can see, these numbers are slightly different. Now, the odd part about Bitcoin, of course, is that you can actually go exchange surfing. And so we could go to like Phoenix, we could go to BTCE, right? And these numbers would all be slightly different. But in essence, they meet the general criteria for the bearish bat, right? So we had a volume divergence, then we had the bearish bat harmonic, and the point about harmonics that's really important to understand is that none of these points represent a trade. you may see the harmonic potentially develop, but the only point at which an actual trade should actually fire is if you have a confirmation of the point D, right? So really important if Mr. Dan DC, if you're watching this video, right, try and remember that we really only want to confirm the harmonic at the point D. You got to patiently wait for all these other points to develop. So at point D, we have volume divergence, we have harmonic pattern, and really all we're looking for is some sort of indication of price failure here to go with the trade. And one of the weeks we teach is candlestick patterns. And here you can see we actually have a few different candlestick patterns working here. This is what's called a shooting star. This is a fractal, all of these put together. This is a inside bar right here, this inside. The long and short of it here is if this level here, which is about 638, 639, whatever these lows are, 638 even it looks like here. If these lows fail, that's a big candle sell signal. All right, we got a number of reasons to take a trade just off of candlesticks alone. So, in comes failure day, doink, right? All the bells and whistles should be going off. If you didn't already have your open order to sell at this fail level, and in the low here, 638 even, so 637.99, let's say, right? 639, 637.98, 637.95, really not the end of the world. You could have worked an open order, and look at this day right here. Boom, the high 639. So you could have gotten your fill. And look again, you got another opportunity to get your fill. So by all means, you could have taken that trade. Candlestick pattern would basically say we're going to risk to the above this shooting star high here, or the point D. And if the market does break point D, then that kind of negates the harmonic pattern, right? Especially if we go up and bust this high here. So if the market could recapture this area and move up, then we want to get out of this trade altogether. But the long and short of it here, and in this case, it's the short, right? And let's say you work the open order this day, right? So you didn't get filled till here, right? Well, that's fine. So be it. Your stop, right? Just above that candlestick high. And what I actually teach in the course, and it's just good practice for new traders to get in the habit of, is if you are considering a trade, only take the trade if you can realistically justify a 2-to-1 risk reward. Now, there are sort of ways that we can come up with downside targets. One trading term I like to use a lot is what's called the optimal trade entry zone. And so if we just did a simple fib off of this low up to this high, you'll notice the optimal trade entry zone is the 61.8 to 78.6 fib, of which we like to call 61.8 our mountain man level in honor of Brandon Rigo, probably one of the best crude oil futures traders I've ever met. And what a coincidence, 61.8 just so happens to line up with our 2-to-1. Right. So had you taken this bearish candle pattern off of the harmonic, off of the bear volume divergence, i.e. 3 legitimate reasons to take a trade, oops, let's go back, right? Then this actually worked out quite nicely. Nice simple trade. If you get in the habit of only considering 2-to-1 risk reward ratios, and let's say you're right only 50% of the time, right? Flip of the coin. Then, ask yourself, are you going to be profitable? The answer clearly is yes, right? The interesting thing is if you can have the discipline to only consider trades with 2-to-1 risk reward, you don't even have to be right 50% of the time to actually make money. I mean, that's the irony of this game. Ideally, we actually, I have 2 rules of investing that I teach in my courses. Rule number 1 is ideally we want our trading algorithm or our 3 reasons to take a trade, the setup, to be about 65% accurate, right? About 2/3. 66 is 2/3. If you can get into that neighborhood and you can have the discipline to only consider trades that have a 2-to-1 risk reward, man, you are going to be an extremely wealthy person, right? Very, very successful traders. And all new traders watching this should understand, when I used to work with the boys on the floor of the CME, Chicago Mercantile Exchange, they were shooting for 55% accuracy. But the key here is your average winner has got to be bigger than your average loser, right? That's the key to trading. It's not being right all the time. It's being right enough of the time, but having the discipline that when you are right, you get paid. All right. So, my new traders, brand new people to trading, I would actually prefer that you book this 2-to-1 profit and just wait for the next setup. I mean, if you think about it, in all honesty, right? Let's say you inherited, I don't know, 5 grand from granny who passed away, right? And you employed proper risk management, so you only risked 5% of your stake on this trade. We calculated that that's going to be 250 bucks. So you're going to target making $500 on the trade. Let's say you only do one trade in, say, 6 months, and you finish the year, right? You booked a $500 profit or 10% return. Hopefully you understand that the average stock market returns over the past like 50 years, annualized returns is like 7%. And with dividends, it comes to about 11%. That's the average annualized return. And this is just one simple trade up, one trade in a whole year, and you can make that. And that's trading your account extremely conservatively. All right. Only taking 5% risk. All right. Obviously, we're going to trade a lot more than that. But let's say, maybe you did like, I don't know, 4 trades in a year. Right. And let's say, right, that half of them work and half of them don't. And let's say you risk 250 bucks, 5% of your portfolio, that $5,000 you inherited from grandma, on each of the trades. Well, so 2 of them are doinkers, right? And you lose 500 bucks on the doinkers. 2 of them are winners. You make $1,000. So net gain up $500 for 4 trades in a whole year, right? And that's batting 50%. Let's say you're bat 75%, which is, professional area, I would say. I mean, really, unfortunately, when you use 4 trades, it's tough to talk about statistics. But just to show you the difference, right? If we now increase that to 75%, you win on 3 of those trades, then now your portfolio is up $1,000, right? 20% return on 4 trades an entire year. Do you have the patience and discipline to wait for 4 of these setups? Remember, this is a daily chart through an entire year. So really, there's lots of money to be made in the market, right? And it's really, if you have the patience and discipline to wait for a setup where multiple reasons confirm a trade idea, you can, right? And this is a nice simple setup where 2-to-1 risk reward is more than realistic, and I think very achievable. All right, now let's move on to a little bit more advanced. Okay, if you get into the habit of being able to identify 2-to-1 risk reward, and you don't freak out when you start to see price moving in your direction, and trust me, a lot of new traders, that's a hard thing to handle. Right? So after a while, after doing trading for a while, you're going to sort of get comfortable with the idea of the market moving in your direction, and you're going to be okay with leaving positions on. Trust me, that's a big learning curve to go over. So, what I often say is first you crawl, then you walk, then you run. If we had done the, say, short off of the candle pattern, right? Boom. Risk the top of the candle pattern. hopefully you guys can understand, maybe a more advanced trader might now consider selling half the position at 2-to-1 risk reward, right? Booking partial profits, right? And then maybe moving their stop to their break-even level, right? And I find it interesting here that when this level was hit, if you look back over the price history, you'll notice that here's where the signal fired, market moved down, then market rallied back, basically back to our entry point. For those people that missed this short entry, they got an opportunity there. And then we started putting in what we call market structure top, right? Where we went up, down, up, breakdown, and M. If you got your fill here at 2-to-1, new traders, take your profits, be happy, 2-to-1, on to the next trade. More advanced traders, maybe look to sell half, stop to the previous market structure peak, which just so happens to be right around your break-even level, so that's okay. And then you're going to simply let the market tell you when to exit this position. So every time you have a new market structure signal, right, that's our M, you're going to move your stop down to that most recent peak. So you'll notice we tanked down to here, rallied back, came back a bit, rallied, and failed to new lows. At this point, on the break of this low here, I can now move my stop from up here to now to here. Market cranks down, rallies back, pull back. See another M developing here, right? Rally, fail, right? I now can move my stop to this high, right? And basically, you just keep doing this. And trust me, this is tough, right? It's not easy controlling your emotions and just letting this trade work, right? They have a saying in the market that you should cut your losers. Like, let's say this jumped up through here, right? Get the heck out. But try and let your winners run, right? So in this case, if we just use simple market structure as our indication when to move our stop, you'll notice that every time it makes a new market structure top, I have permission to move my stop down. Right? And you notice that having this discipline, it took a long time for this to develop. Right? This was an interesting one. Came all the way down here, rallied back, tried to give you a fake out. Remember, there's the old market structure top way up there. Rallied, and then cranked down to new lows. Big drop. I felt pretty good. You know, this is what we call a bear rammy in here. Moving stop there. Another breakdown to new lows. And I mean, look how far away we are from the original trade. It's remarkable, eh? You know, maybe I think I'm comfortable with just the idea for the purposes of this video. We don't really need to get too cute, but hopefully you guys can see how this principle works, right? So our last one here, up, down, up, fail, right? We're really starting to get into some major sell-off territory. You might have left your stop there, maybe moved it up there because that's a pretty big chunk of money. And boom, on this one here, I noted you're stopped. And look at the difference, right? Look at the distance. Quite remarkable. So hopefully that gives you a good illustration of how how a harmonic pattern, not Gartley, this one's a bearish bat, right, played out. How you can use the harmonic pattern in conjunction with two other signals to actually take the trade. How we only took the trade when we had a realistic 2-to-1 profit target, right? And then finally, how advanced traders, and trust me, this is not something that brand new people to trading should try right away, right? You're going to have to take some practice at this. How advanced traders may have only sold a portion of their position at the target and then worked stops as the market worked lower to continually just lock in profits as we got new market structure sell signals. So hopefully that was a nice summary of how harmonics can work within a trade process. Good demonstration of how powerful harmonics can be. And wow, these things can be monstrously powerful. And how you can use the harmonics in the trade identification process. And now this harmonic pattern played out. All right, why don't we leave it at that? Hope you've enjoyed this video. I hope it was helpful to explain a few things. And by all means, if you are interested in participating in our program, it's super dirt cheap, only a couple $100 a month to participate. And as I said, we lay an excellent ground floor on how to learn how to actually be a rational analyst and eat your vegetables. As well, in this first part of the two-part course, we cover a whole bunch of fun stuff in the candy store. And indeed, almost everything that we've talked about here today, where did that chart go? There it is. Almost everything that we've talked about here today was covered in the level 1 course. So if you are interested in learning how to trade, learning how to be a professional trade, handle yourself professionally, how to build setups, how to work off of trading plans, then maybe get back to me and register for our upcoming program. In fact, we have a new semester starting here in May. So if you are interested, you better get to me quick. Most of the seats are gone, so we'll leave it at that. So everybody have yourself a great day. By all means, if you want to learn how more about our live trading room and the stuff that I produce and publish to help you through your trading day, feel free to come on over to our site. And I even think I have the ability to give away some free 30-day trials to our platform. If you're interested, get back to me and I'll send you an email how you can join us for the next month and check out what we do. All right, so everybody have yourselves a great day. All the best. I hope this information's helped you, and good luck in your trading. Bye for now.